Let me start with something you need to hear clearly right at the top, because there is a lot of confusion swirling around right now. If you receive supplemental security income, there is a real change coming to how your bank account gets checked, and it starts rolling out this year. But if you only get regular Social Security, retirement, or disability benefits, this particular rule does not apply to you at all, and I want you to know that before anyone scares you into thinking otherwise. My name doesn't matter as much as what I'm about to walk you through, and if you've ever felt like the government explains this stuff in a language designed to confuse you, stick with me for the next few minutes, because I'm going to lay it out the way I'd explain it to my own mother. You worked decades for these benefits. You paid into this system out of nearly every paycheck you ever earned. So it's fair that you want a straight answer instead of a scary headline, and that's exactly what I'm here to give you. If that sounds like something you want more of, go ahead and subscribe. Not because I need the number, but because I plan on keeping you informed all year as these rules keep shifting, and you deserve to hear it from someone who actually checked the source documents instead of just repeating what some other video said. So let's talk about what's actually happening. The Social Security Administration has been building out something called the Access to Financial Institutions System, or AFI for short. In plain terms, it's a tool that lets the agency check bank account information electronically instead of relying only on what a person reports on paper. For years, the SSA mostly used this deeper level of bank verification only when someone's reported resources were close to the SSI limit, which is fairly low, only a couple $1,000s in countable assets for an individual. Starting this year, the agency is expanding how often and how broadly this electronic check gets used, both for people applying for SSI and for people already receiving it as an ongoing part of keeping their case active. Now, here's the part that matters most to you. SSI is not the same program as Social Security retirement benefits. SSI stands for Supplemental Security Income, and it's a need-based program for people with very limited income and resources, some of whom are older adults, some of whom are disabled adults or children. It is funded differently than Social Security, and it has always required people to stay under strict asset limits to remain eligible. If you are receiving a Social Security retirement check based on your work history or Social Security disability insurance based on your work history, this AFI bank check does not apply to your case because your eligibility was never based on how much money you have in the bank in the first place. I say this because a lot of videos out there right now are blurring that line on purpose, and I don't think you should have to sit there wondering if this affects you when I can just tell you clearly that it doesn't, unless SSI is part of your benefit picture. If you are on SSI, or if someone you love is, here's what you should actually do about it. Make sure your bank account information on file with Social Security is accurate and current. Report any changes in your resources promptly, rather than waiting for a review letter to show up. And if you ever get a letter about a resource review, don't ignore it. And don't panic either. Just respond to it, because these reviews have always happened. This is simply a faster and more automatic version of a check that already existed. Now, since you're here, let me use the rest of our time together to walk you through some other pieces of your Social Security picture that genuinely do affect almost every one of you watching, and that most people never get a clear explanation of from a financial advisor or anyone else. Let's start with your cost of living adjustment, because I know so many of you feel like your check goes up every January, but somehow you still fall further behind. There's a real reason for that, and it's not your imagination. The COLA is calculated using a measure called the CPI-W, which tracks prices for urban wage earners and clerical workers, a group that skews younger and spends money differently than most retirees do. Older adults typically spend a larger share of their income on healthcare and housing, two categories that have been rising faster than general inflation for years. So when your COLA is calculated off an index built around a different kind of household, it's mathematically likely to undercount what you actually need just to stay even. For 2026, the COLA came in at 2.8%. That might sound reasonable on paper, but if your healthcare costs or your rent went up more than that, and for a lot of you they did, you're not wrong to feel like the math doesn't add up in your favor. Here's a curiosity loop I want to plant right now, because I'm going to come back to it. There is a decision you make, usually just once, that can permanently change your monthly check by hundreds of dollars for the rest of your life. And a huge number of people make that decision without realizing how much weight it actually carries. I'll come back to exactly what that is in a moment. But first, let's talk about something else that trips a lot of people up if they're still working while collecting benefits. If you claim Social Security before your full retirement age and you're still working, there's something called the earnings test. In 2026, if you're under full retirement age for the entire year, Social Security will withhold $1 in benefits for every $2 you earn above a certain threshold, which is $3,300 a month, or a bit over $23,000 for the year. In the year you actually reach full retirement age, the rule loosens considerably. They withhold $1 for every $3 earned above a much higher limit, and only counting earnings before the month you hit that birthday. Here's the thing almost nobody explains well. That money isn't gone forever. Once you reach full retirement age, Social Security recalculates your benefit and gives you credit for those withheld months, so your check actually goes up to make up for it over time. It feels like a penalty in the moment, but it's really more like a temporary pause than a permanent loss. Now, let's circle back to that decision I mentioned, the one that can change your check permanently. It's the age at which you choose to start claiming. You can start as early as 62, but your benefit gets permanently reduced, sometimes by as much as 30%, compared to waiting until your full retirement age, which for most of you watching is somewhere between 66 and 67, depending on your birth year. On the other end, if you delay claiming past full retirement age, your benefit grows by roughly 8% for every year you wait, all the way up to age 70, after which there's no more benefit to waiting. Picture two people with an identical work history. One claims at 62 and locks in a smaller check for life. The other waits until 70 and locks in a check that could be worth well over 70% more every single month for as long as they live. Neither choice is automatically wrong. It depends on your health, your other income, and how long you expect to need this money. But the sheer size of that gap is exactly why this decision deserves more thought than most people give it. Let's talk about spousal and survivor benefits next, because this is genuinely one of the most underclaimed pieces of the entire system. If you're married or were married for at least 10 years before divorcing, you may be entitled to a spousal benefit worth up to 50% of your spouse's or ex-spouse's full retirement age benefit, even if you never worked a day in your life, or even if your own work record would pay you less. And if your spouse passes away, survivor benefits can pay you up to 100% of what your spouse was receiving, which is often significantly more than your own benefit alone. Millions of widows and widowers are receiving less than they're entitled to, simply because nobody at Social Security proactively tells them to compare their options and switch to the higher one. This isn't something the system automatically optimizes for you. You often have to know to ask. Now here's something that hits your check every single month, whether you notice it or not, and that's Medicare. If you're enrolled in Medicare Part B, your premium is usually deducted directly from your Social Security check before it ever reaches your bank account. For 2026, the standard Part B premium is $202.90 a month, though it can be higher depending on your income from 2 years prior, through something called an income-related monthly adjustment amount. That means the number on your Social Security award letter is not the number that actually lands in your account, and a lot of people get confused or even alarmed when their deposit looks smaller than they expected. It isn't a mistake. It's Medicare being deducted at the source, and knowing that ahead of time can save you a stressful phone call trying to figure out where your money went. And if your income is genuinely limited, don't overlook SSI itself, separate from Social Security retirement. For 2026, the federal SSI payment is $994 a month for an eligible individual and $1,491 for an eligible couple, and many states add a supplement on top of that federal amount. It exists specifically for older adults and people who are blind or disabled who have very limited income and resources, and it's worth checking your eligibility, even if you assumed you made too much or had too much saved, because the actual limits are often lower than people expect, which is exactly why it catches so many people by surprise in both directions. One more real and fairly recent change worth knowing about, especially if you or your spouse worked in a job that didn't pay into Social Security, like certain government, teaching, or public service positions. For decades, two provisions called the windfall elimination provision and the government pension offset reduced or eliminated Social Security benefits for people receiving a pension from that kind of work. Those provisions were repealed by the Social Security Fairness Act, signed into law in January of 2025, and the change has been retroactive, meaning affected retirees have been receiving increased payments and back pay as the agency worked through implementation. If that applied to you and you haven't checked your current benefit amount recently, it's worth a call or a look at your online account, because this is real money that may already be sitting in your corrected benefit calculation. Here's what I want you to walk away with today. You spent your whole working life contributing to this system, and the amount of confusion baked into how it communicates with you is not your fault. It is not a reflection of your intelligence, and it is not something you should feel embarrassed about not fully understanding, because frankly, very few people fully understand it, including plenty of people whose job it is to explain it. What you deserve is the truth, laid out clearly, without fear tactics, and without anyone inflating a narrow rule change into something it isn't just to get you to click on a video. You deserve every single dollar you are entitled to. Not a dollar more, but absolutely not a dollar less either. So here's what I'd ask of you. If this actually helped you understand your situation a little better, go ahead and subscribe, because I'm going to keep tracking these changes as they happen throughout the year. And I'd rather you hear it from someone giving you the full, honest picture than from a title designed to scare you first and inform you second. And if you have a spouse, a sibling, a neighbor, or a friend who's also navigating retirement and could use a clear-headed explanation instead of another panic-inducing headline, send this their way. You've earned the right to understand exactly what you're owed, and so have they.